In 2019, yields probably have a bias to drift higher. I think what we're still looking at when you take away all of the noise around the volatility is an economy, Joe, as you mentioned, that's going to moderate but still strong. Yeah. We've got a very strong labor market. I mean, all the labor market indicators you look at, we're going to get payrolls on Friday. We've got claims at low levels. The JOLT survey that comes out tells us how many jobs are open. There's 7 million jobs open in this economy that aren't going to get filled, and you've got unemployment at sub 4%. So we've got a lot of strength in the labor markets that I think would lend an upward bias to rates here. And when I look at the technical picture in the bond market, we're also talking about over $1 trillion of deficits that need to get financed next year in the bond market. So federal debt's of $22 trillion, about 15.5 of that is publicly traded. One-ish per trillion on that is what, 6-7%. Plus, you've also got the balance sheet runoff that we're told is going to continue, and I think the market has some issues with that. But you roll all that up, and that you could make a reasonable argument that you're talking about another 25 basis points higher in yield just on the technicals alone. So I think we think that things are biased to the upside. I think another interesting thing that's going on that we deal with at the beginning of every calendar year is this game of chicken that the market plays with the Fed, right? So you've got the market that always wants the Fed to be more dovish, and you've got the Fed in their dots and their projections that has a more of a hawkish view, and somebody's got to blink, right? So the Fed had a blink in 2016. We had the commodity meltdown and spreads got really wide, and we had energy issues in 17. We had that disconnect that had to reconcile itself over the course of 2017, and then in 2018, investors wanted lower rates, and the Fed came out and did them on a regular quarterly basis.
But the next head-on collision is Friday when Powell speaks. What do you think he's going to be saying?
Well, I think what we've seen out of Powell is we've seen they're still trying to get the messaging down, right? So he came out, initial comments, long way from neutral. Market didn't like that. Then they had to walk that a little bit, and I was actually fortunate enough to be at the lunch where he was describing financial stability, but also came out and said, by all estimates, we're pretty close to neutral, and the market really embraced that. So I think it's making this comment.
That was the October 3 remarks that when you say the market embraced it, wasn't that what
the most recent lunch that they did?
It was the lunch at the New York Economic Club.
Oh, when he walked it back.
Right.
You were there, weren't you?
Yeah.
What'd they serve? Was
it chicken?
Yeah.
Was it chicken? All right. Yeah. You were talking about unemployment. Can the consumer, when employment is like it is right now, can the consumer just fall off a cliff because of, I don't know, consumers don't care if the stock market goes down as much as rich people, right? Housing values are down a little bit, but all of a sudden, if it's 70% of spending, consumer 70% of the economy, don't we need to talk ourselves into a recession? How can we just go into a recession when you've got 3.8% unemployment?
I don't think, as you mentioned, the housing, the financial crisis that hit housing, that hits Main Street, right? That market is huge.
Is it happening again? At the top of the show, I said New York real estate's fallen even further, but people around here aren't the Walmart shoppers.
I think you're seeing it moderating. So what you've got is, we know all monetary policy exists with a lag, right? So we've got 9 hikes in the last 3 years, 4 in the last 12 months, and you're starting to see that translate into some of the more interest rate sensitive parts of the market, housing, autos. So it makes sense that we're starting to moderate here. We've had a pretty healthy recovery.
Isn't it the best Christmas season in years?
Yeah. I mean, the consumer's out there, the consumer's working.
All this lagging. I just don't understand where the recession fears come from.
Neither do we, and that's why our view in terms of credit and in terms of rates is a little bit more constructive than some of the naysayers that, you look at the CFO survey that just came out. A lot of CFOs now saying, we've got a recession on the way in the next 12 months, and, we just don't see it in the data unless we are looking at a serious policy mistake by the Fed. And I think what you saw earlier in the fourth quarter, when you saw the 2s, 5s curve invert, I think that was a shot across the bow from the market to say, okay, Fed, we're going to concede you your 25 basis points in December, but enough's enough. You're done. There's no need for you to tighten here. You should be in no rush to tighten, given the outlook for inflation and given the outlook that, the hard part of this whole monetary policy thing is sticking the landing,
right? Have you seen the Depression 2019, 2020 stories?
Yeah.
It's out. Did you see one? Yeah, it's somewhere. depression, 2019, 2020.
I don't see the excesses in the economy right now that would drive that.
That would come from the QE3 that we were, and everything else, I guess.
Or some of these more macro drivers like the
China
tariff
falls
issue.
off a cliff.
China falls off, something like that. I mean,
like,
China's slowing right now. Our expectation is that China sees some fiscal stimulus in 2019. We did ours last year and enjoyed the benefits of it this year. You've got China slowing. Factory orders are lowest they've been in 2 years. So we're getting soft numbers out of China, and we're starting to get the sense that there may be some fiscal stimulus behind that to help smooth out that slowdown.